afternoon it is now, everybody. Welcome to the weekly market analysis session for November 7. My name is Carl Capilingua. I'm the market analyst over here at Think Markets Australia. It's a pleasure to be with you as we delve into all the key events from last week and have a look to the week ahead. First off, we'll start with cryptocurrencies. And I have to take a snapshot of these somewhere. It's a market that trades 24/7. So I go Saturday to Saturday. So I understand that some of the moves may be different based upon what happened on Sunday and Monday. In fact, cryptos are pulling back a little bit. So order of magnitude, Bitcoin down, most of that 2.5%, and Ethereum is down 3 or 4% as I speak. But for all intents and purposes, it was a fairly positive week for cryptos. Binance Coin, I've got a chart of that coming up pretty soon. Up 17.5%. Actually, it is a very nice chart. Avalanche, Solana getting some love there. Again, some of those gains backing out since Saturday's close. Have a look at the Fear and Greed Index. It is up, however, not, rocket ship emojis up, but it is up to 33. And you can see that is up from last week's 31 and certainly well above last month's extreme fear reading of 24. Not a great deal of a narrative going on in crypto at the moment. It is still very much consolidating after weakness through August and September. I think there's a great sense of relief that we didn't break lower in October, particularly on Bitcoin and Ethereum. I'll show you next. And with a little bit of risk on coming back into stocks, particularly US stocks and last week Chinese stocks, I think we're seeing the seeds of a bit of a rally, or at least potentially, I'm hoping, a thawing of crypto winter. Binance Coin, I promised you that chart. I think it looks pretty good actually, and we've got a short-term uptrend as you can see on screen. And that's the light green zone, and the long-term trend is starting to change. So I use a traffic light system for my long-term trends. You can see dark pink. Substitute that for red. That would be obviously not going long, but potentially going short. Green, you can only see that at the far left. That was green is go for longs, and we're transitioning back to orange, which is that sort of period in between. What's different from this orange period the last time we held that long-term trend zone. We pushed back down, get down again. This time we pushed through it, and actually the price action is starting to look pretty good with high peaks and high troughs through here, and some really nice white candles coming through. Yes, there's been a bit of a pullback over the weekend, but I do think areas like 315 should hold, and if you do see some nice demand side candles, so candles with white bodies and or lower shadows in and around that zone from, let's say, 325 to 315, because there can be some volatility in crypto, then I think you could add some to this position if you don't already have it. I think more broadly speaking, the break above 337 is very positive. Having a look at Bitcoin, we can see it's not as good as Binance Coin. Incidentally, most of those online exchanges and dexes are doing quite well. So go and have a look at some of those. Back to Bitcoin, of course, we can see high peaks and high troughs. That's encouraging. We see some decent candles, even that Friday, or if that's a bit of a Monday, Sunday, it could be Saturday, Friday candle there. Very strong with just a modest pullback. 20,000 handle, I think, moves to support now. Resistance, well, we've cleared 24.50, 21.078 has been at least challenged. So 22.793, I think, is that next key level, and it does take us back into that long-term trend zone, which we will need to deal with if we want to turn this Bitcoin trend. I wouldn't get too excited, however, until we broke above 25.366, and we're still lacking probably a bit of volume to get rid of some of that supply to tell us we've had some supply removal. We can start that uptrend. Look, I did see it in Ethereum, so you can see a bit of a volume pulse through here as we got going. We pushed off that base from 1200 down to 1180. I'll just go back to Bitcoin. Just go back to Bitcoin. I'm going all over the place now. Back to Bitcoin. I'm going to blame PowerPoint for that one. Back to Bitcoin there. And I talked about the fact we didn't break through those lows at 17,585 during October. I do think that is positive. Ethereum, similar sort of story, but we have moved into a much better price action trend here with, I would say, better candles. Holding 15 handle, that's kind of your 20 handle on Bitcoin, and pushing high through 1664, I think would be a big positive, closing above that. And then 1790 is that key level, but really 2031, that's kind of your 25,366 on Bitcoin. Until we get through that, I don't think we're going to have enough sort of FOMO and sort of stimulus through the let's call it the cryptoverse there to get things going. So we just need to see a little bit more positivity to stimulate some more demand, as tends to be the case in crypto markets. Bottom line is, look, some risk on is coming back in the most risk-on area of financial markets. Evidence of risk-on is the decline here in the volatility index that's on screen. I might just switch myself off there for a second so you can see what's been going on in those equity indices. So it's pretty unusual to see the volatility index come down like it has when you're seeing 5.6% falls on the NASDAQ composite. Very unusual. Normally, when you're seeing those sorts of declines in US equities, that volatility index is rising. Look, probably queuing more on a substantial rally in China. That was the source of some volatility recently, and the steadying of the ship there, I think, has helped. If you haven't followed the rumor mill there in China, there were a number of social media quotes from various quote unquote, I wouldn't even call them authorities, but or officials, but some people of significance within, let's call it the sphere that handles the COVID crisis over there, that there was potentially a committee being set up to plot a path out of lockdowns. Whether it was that, whether it was just a whole heap of short covering, whether it was some strategic buying from Beijing and Beijing-backed authorities to try and manufacture a bounce, that's what we got. And some of the huge declines we've seen, particularly in technology and real estate companies, which are under the pump, let's face it, bringing down those broader indices. We have seen a bit of a reversal there. Shanghai Composite up 5%, Hang Seng up 8.7%. The reason why the US was so poor, we'll talk about in a second, mainly to do with Jerome Powell, mainly to do with markets getting very excited that there would be a Fed pivot, a more dovish Fed pivot. Didn't happen. He was as hawkish as ever, and that's why we saw markets reverse. And your more interest rate sensitive of your NASDAQs were the hardest hit. It's crucial you understand there's so much information in these three lines here. NASDAQ down nearly 6%, yet the Dow Jones only down 1.4%. So there's this massive favouring preference for value over growth at the moment. And I do think that is telling not only of the nervousness out there, but also the fact that there is still cash on the sidelines and it needs to be put into equities. It is mandated to go into equities, and that is causing outperformance of those larger cap value stocks. Talk a bit more about that as we go. If we had to go best out of three, you're going to go Asia was a bounce, Europe was a bounce, and it was just the US that was down. So let's call it 2-1 in favour of risk on for equities. Have a look at some of the charts now. Pop myself back up there. You can see the S&P 500 still a bear market trend here, still very much on the traffic light system, and actually quite evident here how the traffic light system works. Dark pink zone means you would still be favouring shorts and having very high cash levels. Having said that, short-term trend is starting to moderate back up to the upside, or being less bearish. It is neutral at this stage. It would have been better if not for the Jerome Powell. That's the fall there. Which was, I think, Wednesday is my guess, based upon the fact that that's Friday and that's Thursday. So that was that decline. But look, Thursday, the ship was very much steady, and Friday we actually pushed higher. So I'm going to say this high peak, sort of high trough price action, although there's a bit of a blip, I'm going to say that's largely intact. And if anything, my preference is to, to trade with the short-term uptrend, but be very, very vigilant that we're still in the long-term downtrend. In terms of key levels here, 39.12, get back above that this week or next, and it's starting to look fairly bullish actually for a decent bear market rally, which then could go challenge that dark pink zone. To the downside, I don't think we want to see it make another peak sort of in this area here around that 38 to 3900. So if we saw some supply side candles, so black candles or upper shadows in here, imagine them in here, I think then you would actually go with that longer term trend and trade for lower prices. But there is plenty of demand, 36.47, 36.98. I think there's a zone in here. And then of course the big one around about that 3500 to 3600 handle. I see plenty of demand. I see this downtrend here, absolutely, but I can see plenty of demand in the system. It's not going to be an easy one for the bears. Looks a little bit easier on the comp, because it is more of a risk-on market, and we're going to see in the next chart in particular how value and growth are playing against each other. This one looks far more bearish. Break of 10 handle could be really interesting actually, because a break here might actually just kibosh this whole value-based strength and just pull everything down. Definitely watch for that this week. It's not impossible that occurs. Probably more likely though, we see the NASDAQ move in line with that broader strength underlying strength in that short-term trend on the S&P 500, and the Dow we'll see in a second, and maybe go back up and test 11,210. But I'd be silly to make a call one way or the other, and that's not me sitting on the fence or copping out on this. It's just the nature of the technicals we can see right now. We are caught between demand and supply at this point in time. A break of 10 handle, as I suggested. That's definitive move. A break of 11,210, it's starting to be a bit more definitive the upside. And whilst you're in the middle, I think keep risk levels very modest. This is the value trap potentially for that investors need to deal with at the moment. So the Dow Jones Industrial Average, you can see just how strong it has been. And most of this is juiced by your big defensives like McDonald's, MCD on the New York Stock Exchange. Go check out that chart. I mean, that is a monster. It's 12-month highs, if not all-time highs. I'd have to go and zoom out on that, but I definitely looked at the chart and it was definitely bottom left, top right. But your other defensives like United Healthcare doing very, very well. Some of your financials, your Goldman Sachs, JP Morgan also doing well, Coca-Cola. So it is being bench pressed by your big defensive names there. And don't forget that your big pension funds, that money keeps rolling in. Unemployment is at, let's for all intents and purposes, record lows. So people are employed, then saving for their retirements, and they're putting in their 401ks. Locally here, they're putting in their super funds. And a large portion of that, if you're in your typical balanced fund, about 40% is earmarked for equities. It has to go in good, bad, or ugly. So we have to understand, it doesn't matter how bad the economy is or how bad it's going to get, or what Jerome Powell is saying, there is mandated investing going on. But when they invest, they will strategically try and focus on liquidity. So those big cap stocks they can get out of, obviously they feel nervous about the situation. They'll target those big caps and get out of them quickly. And then those most defensive names that they know will still be there on the other side of the cycle. And they're going to not invest in your riskier stocks. In your NASDAQ. Okay, I've been saying for a long time now, I need to see this do better. So we've got the iron ore chart here. Let me take 1 second off you to double check. I haven't had any questions. I do have a question here from Jeremy. Is anyone else having trouble with audio cutting in and out? Somewhat. I don't know. Haven't had any other reports, Jeremy, so apologies on that. Hopefully it has rectified itself since your comment. But what I have said is that I do want to see industrial metals bounce back significantly to tell me growth is coming back. There was a rally on the iron ore chart. As you can see here, this is a Singapore-based US dollar price for iron ore bouncing off those lows at 76.30, holding that key low there from 1st of April for the charters to zoom out, find that low at 75.66. Really important because beneath that, we're heading into the low 60s. I think 62.50 is the next one, and then mid 50s after that. Much of that was the Chinese rumors, and it just kept pumping and pumping and pumping all week. I could not believe that 3 tweets or whatever it was juiced the market so much. But short covering, I do think, is a play. Longer term, the trend is still down. I'm not that impressed, and I would be favouring continued downward bets on this one. Otherwise, metals got a boost last week on substantial US dollar weakness on Friday. We'll talk about that in a second, but that was the dominant theme here. So, high-grade copper up 8%. Most of that's on Friday's candle, as we'll see. Nickel up 7% once again coming on Friday. London Metals Exchange there, you can see also up with copper. Iron ore, you can see the bounce there, and some of the precious metals also bouncing back. Let's have a look at some of those industrial commodities now. So this is the stuff that is going to go up if global economic growth is pumping. Coke and coal, that has actually rallied. Look, it's flattening out a little bit, but I think this is more to do with supply side shortages. There has been some extremely wet weather over on the east coast of Australia, and that is causing some restricted supply there on Aussie coke and coal, so that's helping the price up. There's the big move. This last candle here on copper, it doesn't look right. It just it's surreal. It's like somebody went in there and just painted that giant white candle on, because it's so at odds with everything else that has come before it, and the everything else before it is keying off this significantly weaker outlook for global growth going forward. And then you have to say, well, what is going on there? We'll investigate that in a second. It is a little bit perverse, so hang in, stay tuned for that one. Nickel getting a bounce and actually clawing itself off the lows. I guess long-term trend still down, like copper, and gold getting the benefit of that as well. Key levels for gold. You know, I'm not a gold bug. You all know that. It's still a downtrend. Look, if it gets above 1735, it might start to look interesting, but really it won't look interesting until it gets above 1808. The downside for break, say 1613, I think it's got a long ways to fall. Having a look at energy markets now, they did better during the week, mainly on Friday, as you can see, but crude oil I think looks pretty strong. I think there is a bit of an inverted head and shoulders pattern going on here. I don't think it's going to explode necessarily. I don't think the demand supply dynamics are necessarily there for that, but it can, I think, improve probably back into the 100, 105 level. That was up about 5% last week. Natural gas was a big move. That's something that's looking quite interesting, actually. So we do have a natural gas contract at Think Markets you can trade with CFDs, and encourage you to check that one out. Aussie dollar got a bit of a bounce, mainly on that US dollar weakness. We'll see in a second. Somehow the US dollar index did eke out again, but that will be short-lived, I would expect. And bond yields rose on Jerome Powell's hawkish comments. This is the natural gas chart I was talking to you about. Certainly short-term downtrend as we had this unseasonably warm fall weather in the northern hemisphere, and to be fair, those stockpiles were built up pretty well, but bouncing back quite nicely here, and above 720. Maybe if the weather starts to turn a bit cooler, you could get a bit of a push on there. You can see how much of it though was a currency based move, because the TTF over there in Netherlands didn't get any love. Coal prices are trending lower. I think for the coal bugs out there watching our coal stocks, there is a downtrend there, and I think that is eroding some of the that strength in that sector. We know this has got to come down at some stage. It's not if, it's just when, and the when is to do with people wanting to keep warm, supply side shortages, which are a key factor. Again, East Coast supply being significantly restricted. But don't forget, a lot of those coal stocks I do think are priced for perfection. I've advocated trimming some profits there. I haven't said to get out of everything, but you could be trimming, a third to 2/3 and hanging in with just partial position. Uranium looked like it was going to get going. It didn't. Last week it pulled back. Some of those energy contracts, their coal sort of pulling back, in uranium, I guess, is a direct alternative to that. We would love to see it break above 52.70, probably 54.60, to really get excited about it. And there's the move. This is the key move in today's presentation, without doubt, is that huge black candle there on the US dollar index, which created the huge white candles all over the bloody place else. And it's actually, I'd say this is quite bearish. I mean, if this was a stock, I would be in trim mode. So if I would have been long, as you know my style, I'm a trend follower, so double green is go. But I would be trimming here my exposure, just because I think there's just too much supply. There's too much evidence of supply up around that sort of 113 to 115 level. However, the long-term trend is still up, so you have some skin in the game. But I think sort of below that level, it's about 109.5. It's starting to look pretty bearish for a deeper move back into maybe the 107, 106, and see how we go from there. But a lot of that could facilitate some short covering in some really beaten down trends. For example, the Aussie dollar, some of obviously your other major crosses against the US, but some of your commodities as well. We saw what it did to copper earlier on. So this is important. There's a few markets at play here. Australian government bond yields up slightly on the back of the Reserve Bank meeting. We'll talk about that one in a second. US 10s up again on the back of Jay Powell's commentary, and the 2s got a big boost. Obviously, short-term rates still pumping a lot harder than those longer-term rates. But Friday's candle was interesting, wasn't it? So see that big push in the shadow there of 5%. Let me say that again. 2-year yields in the US in the shadow of the 5 handle. But coming off there was some supply there, probably some profit taking, short covering, I guess, on your bonds because of the inverse relationship between that chart and your bond prices. Having a look at, this is my favorite chart every week, because we're looking at the US 2s to 10s yield curve. So what we're looking at here is, of course, the price of money through the spectrum, and what you're supposed to see is money in the longer term costing more than the money in the shorter term. It's not what we're seeing right now. We're seeing the opposite. Obviously, the yield on the 2s way higher than the 10s. Why? Because we're in a tightening cycle from the Fed. And why are the longer term yields lower? Well, because the expectation is that the Fed is going to break the economy and break it pretty well, and therefore rates will have to come down at some stage. and that's what we've got. That's why the yield curve is inverted, and literally 9 out of 9 times that has occurred historically over the last, whatever it is, 50, 70, 80 years, I don't know. Go Google it. That we have seen a recession. Let's have a look at some of the key data out during the week. We did see 75 basis point increase to the cash rate from the Federal Reserve to 3.75 to 4%. You can see the history of increases so far this year. It was largely in line with expectations. However, some were expecting 1%. So I think markets rallied initially on that. And then there was in the press conference with Jerome Powell afterwards, whether it was right or wrong, one of the journos said, hey, markets have reacted positively to this development. And Jerome got quite annoyed and said, hey, that's not what they should be doing. Markets need to get the message here. The incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. It is very premature to be thinking about pausing, and that was that big black candle on those US equities. Markets factoring 50 basis points at the December meeting, but then dropped 25 basis point hikes, 2 more of them after that. We're looking for a peak in the cycle there at 5.14, which is up pre-meeting from just over 5%. Looking at some of the jobs-based data from the US during the week, we did see the JOLTS, so the job openings actually pop back up. That's a little bit counter trend from recently. I'm looking more at, the highs and the fires. So you've got the highs in the light blue line and the fires in the dark green line, and they were both down. So obviously hiring's down, which is not great for the US economy. And then I shouldn't say highs and fires, I should say highs and quits. And quits are down as well. So obviously you quit your job if you're really comfortable in getting another job. You don't quit your job if you're not comfortable. And we did see the number of quits come down. US weekly jobless claims, no big deal there, but they are slightly elevated over the last few weeks. The big data was all about this non-farm payrolls. And on the face of it, looked like a scorcher. I mean, market was expecting somewhere around about 195. I did see 197 up to sort of just over 200, but median, let's call it 195. We got 261, so way above expectations. And then we had a revision of about 50-odd thousand jobs from last month as well. So from the September reading, so massively positive on the surface. Having said that, it is still the weakest print we've had for many months. So that's interesting in itself. The unemployment rate just ticked up very slightly, and participation ticked down, which is not good. People becoming more disillusioned about being in the workforce. But this is what we call the establishment survey, and it doesn't take into account a lot of double counting in this employment data, where, for example, the household survey, which is literally interviewing households, takes into account that double counting. So if somebody's just taken a job, 3 part-time jobs up in the last month, that's going to be shown at a much higher rate on the establishment survey than the household survey. The household survey fell by 28,000 jobs off the top of my head. It could have been 358. Somebody, I'm sure, is shouting at this screen, correcting me. The bottom line is it was a bunch of jobs shed, according to the household survey, in the month of October, and it's something like a $600,000 job discrepancy. And this is what tanked the US dollar, because the expectation is, well, how can the Fed continue to increase rates when the underlying US jobs market is weakening substantially? We did see also a sharp jump to the number of unemployed people to over 6 million. So it really didn't get many headlines, but the headlines were that US dollar print and how it impacted everything else. So now you know. I have a look at some of the other data during the week. I just realized I'm covering my screen there, but that's okay. I think I described everything that was happening in the last image. Very quickly here, I don't need to spend too much time. Generally, PMIs in China were weaker than expected, both for services and manufacturing sectors, and importantly, falling below that 50 mark, which delineates expansion above 50 and contraction below 50. Luckily, we have our Reserve Bank interest rate decision, which looked a little bit benign, to be honest, at 25 basis point. The market rallied, though, because, to be fair, it was sort of a 54-46 skew in terms of expectations toward a 50 basis point hike. So there was a little bit of a positive surprise in that. And markets, I think local market at the moment just wants to look at anything positive and focus on that. We'll look at the chart in a second. Terminal peak tightening now, edged back up to 392. That's interesting, because after the last meeting, where our RBA did pivot, going from 50 basis point hikes to 25. That dropped as low as 3.5, and the peak was about 4.5. So we're sort of somewhere back in between, and that is expected to peak around November 23. That's not good for markets. That's not good for stocks. But anyway, as I said, markets focusing on the more positive, that it wasn't 50 basis points this time. Some more negatives. CPI expected to peak now at 8%, according to the RBA. That was 7.75%. So they ratcheted up their expectations for inflation both this year and next year, substantially next year. Was 4%, now 4.75%, which is high. It's way above their 2 to 3% average, and not getting back anywhere close to that average until 2024. So this is inflation is not transitory, and coincidentally, it was supposed to be 2024 when we get our first interest rate hike. Thank you, Governor Philip Lowe. Geez, all I had in my head there was Jerome Powell. So Philip Lowe locally. GDP downgraded by 1/4 basis point, both for next year and the year after, and 1.5% 2024 is slow. Unemployment to rise to over 4%. That estimate was previously 4%, depending on your think tank estimate, somewhere between at least 100,000, but potentially up to 250,000 jobs to be lost in the Australian economy over the next 12 months. Will it be you? I hope not. Probably somebody you know, though. So anyway, markets were up just during the week. Plenty of green on the screen there, 1.5% for the S&P ASX 200. But energy, we saw some of those gains in energy markets there, up 5%. Materials did well, up 2.6%. Some of those based metals rallied. Laggards, clearly property. They don't like it when interest rates go up, and we did see bond yields go up. Discretionary, well, I wouldn't call that an underperformer, but that is another one of those interest rate sensitive sectors. But the defensives, interesting, very interesting to see healthcare locally and staples. The two key defensive sectors were down I shouldn't say that. Staples was down, healthcare 0.4%. Underperforming is what I meant to say. So again, it's very much a materials and financials based rally going on locally, and that's where the index points are. So it does reflect what's happening on the Dow. If you are an Australian fund manager, you have to invest. You're going to target those big four banks, your BHP, your Rio, your really liquid stuff that is quite unquote safe. You can get out of if you need to. Having said that, market breadth is improving across the board for the Aussie market. Okay, improving, not great, but improving. The goal here is to get closer to that green zone, which is the bear market. So we're talking about participation in the rally. This is purely technical analysis here. The number of stocks participating in an uptrend over the various timeframes on their exponential moving averages. So you can see roughly 2/3 of stocks are below their 1-year trends. That's not good. That's not a bull market. That's still bear market stuff. For a bull market, we should be seeing 2/3 of stocks above their 1-year trends. But we can see here some significant repair has been done over that sort of 2 weeks to 1 month period. We're actually getting pretty close to a bullish mark on that, but it'll take time to repair. But it is getting better, as you can see here, also in the sector technical trends. So looking at those short-term and long-term trend ribbons, the traffic light system we talked about before, and this is just putting it into one table. S&P ASX 200 is now short-term uptrend, long-term downtrend, but that downtrend is almost neutral, to be fair. Discretionary up, down, energy and financials, the only two ups there. As a trend follower, still have to say, stick with those sectors. Gold got itself back up to neutral, but healthcare, infotech, and interesting, the materials sort of down, but materials, I could almost write neutral on those. Property trust back up to neutral with that rally. Property trust back up to neutral. Telecoms with the rally last week back to up, and utilities up to neutral as well. Have a look at value. On the Aussie market, we're looking at the 1-year forward PE. So these are Thomson Reuters estimates. They survey somewhere between 15 and 20 of the biggest research houses, fund managers, where those investors believe earnings are going to be in 1 year's time, and obviously looking at the PE. We would say fair value is about 15 historically. 15 is considered to be where the market is fairly priced. 20 is considered to be expensive, and you look at the big highs of 87, 29, GFC highs, they all peaked above 20. Okay, that's just clockwork sort of stuff. And the lows corresponding all dipped below 10. So look, we're on the right side of fair value. I think that's the message, but a lot of it's been bench pressed by the energy and material sectors, which are cycling big earnings bumps, and those earnings are expected to fall by 20 to 30% in some cases. So that's just in the next 12 months, and over the next few years, expected to pretty close to halve. So I think that is bringing it down. I wouldn't necessarily say that Aussie market's all that cheap. Financials is about fair value. Infotech is still expensive, looking at the pre-COVID average there. And then you've got something like a discretionary, which is still a little bit expensive. If you want to go to the cheaper end of the spectrum, possibly, well, I shouldn't say possibly, property starting to look really cheap there. It's obviously one of those sectors that suffers the most when interest rates go up. Other cheap ones, struggling a little bit, aren't I? Maybe utilities looking a bit cheap, and I should have mentioned healthcare is still looking really expensive compared to long-term averages. Upcoming week ahead in Australia, we do have the Westpac Consumer Sentiment Survey coming up tomorrow, along with the NAB Business Confidence Survey. RBA Governor Philip Lowe speaking on Tuesday at 8:30 p.m. Sydney time. And then pretty quiet from there. Looking abroad, it's all about inflation. This week, we do have Chinese inflation data coming up Wednesday around about lunchtime, Sydney time. And then the big one will be Friday morning, early Friday morning, Sydney time, the US Consumer Price Index. We are expecting 0.6% on the headline, 0.5% on the core, and a year-on-year reading for the headline of 8%, easing slightly from the previous month's 8.2%. And then we will get the University of Michigan preliminary reading there on their consumer sentiment survey, coming down again to 59.5, and that has come down a long way. Well, that's it for me today. If you want to hang out with me for an hour tomorrow, I will have a look at your portfolio, give you a technical and fundamental reader on those stocks. So that's the registration link there, www.thinkmarkets.com/au learn to trade /webinars. I should fix that because you can get rid of the learn to trade and just go to webinars and register for that. If you are not familiar with Think Markets, we are the good guys in the Australian stockbroking industry. We have over 3,100 shares and ETFs via self-managed super fund, $8 flat rate per trade, cheaper than all of the Compsex and Westpacs and things out there on your flat rate. Hin and Chess sponsored as well. Now, there are cheaper rates out there, but they're not Hin and Chess sponsored, and that is really important for your self-managed super fund. But hey, if you want to trade some of the more exotic instruments out there, you can do so with CFDs, so contracts for difference on natural gas, crude oil. Thought that chart looked pretty good. Even if you wanted to take a punt on high-grade copper, you can do that with a CFD. And if you just want to trade your shares, you can do those commission-free as well. FX, commodities, crypto, maybe Binance coin, all in the same account area. You're all managing it from the same account at Think Markets here. So you have your self-managed super fund trading your shares on one side, your lithium and uranium shares, and then you have your CFDs on the other side. Head to thinkmarkets.com/au for details. Award-winning broker. We've been around for a long time. We've won many awards. We are regulated in all of the key jurisdictions around the world. For example, the United States. We just opened an office in Japan. We're in the UK. We're in South Africa. We've got a bunch of offices throughout Asia, and obviously Melbourne over here in Australia. We are regulated by the Australian Securities and Investment Commission. World-class trading apps on your phone or desktop. Dedicated account manager. You speak to the same person who gets to know you. 24/7 customer support. If you're watching me on YouTube, hit the subscribe button. If you're watching me on Twitter, hit the follow button to stay notified of any of my future updates. And hit the like button to let me know you like what I'm doing, so I continue to do more of it. That's it for today. Hopefully you enjoyed the presentation. All the best for your investing. Till we catch up again. Bye-bye for now.